Hey, good afternoon, everyone. Today we've got Mark Nuzzo with Energy Pricebook. Mark, welcome.
Thanks so much for having me, Scott.
We've talked a little bit in the past about Energy Pricebook, deregulated energy, how your clients and mine might be able to utilize our services to help them to price their electrical power for future contracts at a better rate to save money. A lot of those types of things. Today, we want to dive a little bit deeper into just what that's all about. Some background as to what's causing prices to increase and how we might be able to help them. So, Mark, I'll let you do a quick intro for Energy Pricebook and tell us a little bit about yourself, and then we can dive straight into some slides that we have set up for today.
Sure thing. Thanks again, Scott. Again, Mark Nuzzo with Energy Pricebook. I've had the privilege of being in retail energy for now over 25 years and had the opportunity to evaluate and source power and natural gas in various markets, rising, falling, sideways. And throughout that whole process, what's constantly asked by commercial and industrial businesses is what's a good price for my specific energy, my custom energy for my specific location, my specific load profile, my specific start month, my specific forward term. And Pricebook simply launched out of that market need to answer that question because, as probably most listeners realize, it's a very inefficient process both on the buy and supply side in order to get custom energy pricing for a business. And Energy Pricebook simply automates that price identification process as well as automates the price monitoring process for custom energy prices.
Awesome. Okay. Well, we have some slides to look at today, and while I'm pulling those up, let me ask you a couple of questions. So, in the years that you have worked in this industry, can you think of a period? Let's not even look at it from the perspective of year over year, but maybe a 3 to 5 year period. Have you ever seen electricity go lower? Is it getting cheaper?
There was a period of time in about 2014 to 2020 where markets actually went lower.
Okay.
But other than that, they typically over a 10-year period, at least for power, have continued to rise, especially in the last 3 years.
Okay. Well, let's take a look at some of why that has occurred. And Mark, I know you pulled some charts together for us to explain this, but I think that they'll help the audience to understand a little bit more about why the prices are where they are and where we're likely headed for the future.
Absolutely. So, over the past 25 years, the one way to look at it is you could take 3 sections over those last 2.5 decades and break it out between 1999, when deregulated started, to about 2014. And then there's this middle period of about 2014 to 2020 where the markets basically were flat. And then post 2020. So on this graph, the y-axis is the average electricity price in the US. Now, again, this is a general average across multiple profiles. And what you could see that used to be, say, 6.5 cents in 1999 is now approaching, say, 13 cents. And what you see when you look at this, in the first quarter break or third breakdown of this from say 99 to 2014, there were simply market events that were driving pricing, whether that would be, 9/11 terrorist attacks to maybe businesses like Enron collapsing to hurricanes and storms, whether they were called, Katrina or Ida or Sandy, or economic movements in the housing market or the financial crash of '08. But throughout all that, there was obviously economics wise a supply and demand component. And then about 2014 to 2020, the markets went sideways. And those were very what we would consider easy buying and risk management period, where as you as a broker or consultant or an advisor could go to your client and say, hey, you're paying 6 cents, your renewal price is at 4.5 cents. That's a very
Mhm.
easy conversation to have. And if you're an end consumer listening and you're on the procurement team or energy management team, you would go to your stakeholders and signatories and say, we're currently contracted here, the renewal terms here, and everyone was happy. And that was the case until about 2020. And for various reasons, whether that would be, a pandemic with COVID, whether it would be a particular weather events like a Texas freeze that exposed the Texas power infrastructure market and exposed it of certain weaknesses and frailty that needed to be built up, or the Ukraine war that impacted supply of say natural gas, or even the global demand of natural gas, and how that bled back into electricity prices. So once 2020 hit, as everyone knows, prices catapulted, and they catapulted for energy. But
Mhm.
what's different in, I'll say, the post 2020 than it was, say, in the first part, of the 2000s, is over time, each state has increased their RPS, which stands for Renewable Portfolio Standard, anywhere from 5 to maybe even upwards of 10 times. So what used to be, say, a 3% component that needed to be renewable power being solar, wind, biomass, hydro, etc., is now at 30%. And that renewable power comes at a premium cost. In parallel with the increasing renewable portfolio standards, coal and nuclear power plants were taken offline. And then on top of all that, natural gas drilling, at least on federal lands where there were known reserves, largely got limited. So a lot of things were happening at the same time from a supply standpoint, which basically throttled back our supply. And then in parallel with that, as everyone has heard, whether it would be with electric vehicles, AI edge computing, the growth of data centers, the need for data streaming, the demand for electricity just continues to grow. So, not to oversimplify this, but in this current rising market where infrastructure costs have risen and the supply has gone down and the demand has gone up, we're in the hardest market yet in terms of managing electricity prices, monitoring electricity prices, and most importantly, risk managing that particular portfolio and how it impacts your budget and bottom line costs.
Interesting. When I look at all of the items that you have in the segment to the right, where you've got rising infrastructure costs, and of course all the other factors that are contributing to that, and I look at what the real inflation is. I'm not talking about the CPI and what gets reported, so we feel good about it. Um, we know that construction costs are incredibly high as a proportion of as we look at inflation. If you took construction costs into account, it would blow that out the water and make that number much higher. Um, I would guess that that has an impact. We also are seeing the A dollar's not worth what it used to be worth, obviously. I can't see the renewable requirements decreasing at any time. I can only see them increasing. I guess what I'm saying is when I look at this, and God forbid we have other events, some of those are natural disasters, which we obviously can't prevent. Others are perhaps politically induced or contributed to in some other fashion. I'm not sure I can see a future where we don't have continued increase in prices across the board with energy costs. Would you agree?
I would agree. For the foreseeable future, it would appear that way. One thing that just came out, actually, my business partner sent me this morning, was this headline. And again, quite candidly, as we jumped on this podcast, I didn't have time to read this, but
Mm-hmm.
it's getting so obvious now, and it's been obvious to those in this space for years, that nuclear power plants, which used to be demonized, which by the way have zero emissions in terms of carbon emissions, there are other risks to it, obviously, to where this
Mm-hmm.
headline comes out where the White House now supports nuclear power plants in the US. I don't necessarily know what that means, but it's getting so obvious in terms of a decreased supply and an increased demand that something needs to be done. Now, whether it's being done from a headline purpose or an actual implementation purposes, that's to
Yeah,
be
never
seen.
know.
But I can tell you, um, 3 years ago, I don't think you would have ever seen this headline, but it's getting to the point of, I don't necessarily say breaking points, but the infrastructure is stressed.
Interesting. So when you hear about energy prices and the fact that they're rising, what are the specific indices that are referenced there, and how is that made up?
So again, when you hear about energy prices, and we'll talk specifically about electricity, and that there's various energy commodities, electricity and natural gas being two of the bigger ones. But for electricity, there are there's basically a real-time market and there's also a day-ahead market, but we'll just lump that into a real-time market, and then there's a forward market.
Hmm.
So for a real-time market, it's exactly what it sounds like. What the price is trading at for that particular moment in time for power. So if you were literally riding the market, it would be, what's the price of power at 10 a.m., what's the price of power at 1 p.m., etc. The other market, and this is what's on the slide deck now, is a forward market. And that is typically how electricity is purchased. So when you look at a particular area around the country, and this particular graph shows the PSEG market in northern New Jersey. And again, each area of the country has different infrastructure costs. So there are about 75 plus hubs, and they're mainly trading hubs, wholesale trading hubs, that electricity trades. And
Hmm.
then each hub represents a given distribution area. So if you had, say, a chain of quick serve restaurants in northern New Jersey that sat behind the PSEG hub, the prices that you see here would be influencing what you would be spending in the forward market. So let's talk about what the forward market is. So this is as of this data is as of May 27th. So when you're talking about electricity, you got to have obviously reference certain things, what day you're on in terms you're talking about it, and specifically what forward term that you're talking that you want to lock in. And that breaks down into a start month and a term length. So what we're seeing on this slide here are calendar strips or forward calendar strips as we sit on May 27, 2024. So when it turns to be this January 1st, 2025, this calendar strip would go away, and we would then add 2030 as the next forward calendar strip. So, for example's sake, what we see here trading, and what's this blue line, at least on on my chart, is the 2025 calendar strip, which really means a breakdown of 12 calendar months. So electricity is traded by forward calendar months, and you'll see January 2025, February 2025, all the way to December. So 2025 is a composite of these 12 months. Calendar strip 2026, a composite of these, 27, 28, etc. So what is trading, and this is for a round-the-clock RTC profile, meaning what energy would be if you consumed it 24/7. That price is currently trading, at the, say, around the $44 level for that forward calendar strip of 2025, meaning January 2025 start for a 12-month term. That same strip 3 or 4 years ago was trading down at $28. So it's been a drastic increase, for that particular calendar month. But if you look at, for example, 2029, that's even a higher increase to where it used to be. So what's needed in today's market is this price monitoring for these forward strips. So when you go out to bid your electricity, you can structure bids in that. What do I want to lock in? What do I want pricing for? Do I want it for, 2025 through 2029? Do I want to just look at, the short-term years, the long-term years? So that is the breakdown of a forward market. The difference, and where you hear a lot of the talk, say, on television, would be the real-time market. So what you're seeing here, this is the day ahead, or there's also a real-time market, but the day ahead market's similar to real-time. And these are the same time periods for the real-time market. So what this graph is showing, and I'm just going to zoom in, this on January or March 1st, 2021, this is what the price of electricity was trading at if you consumed it on that day. And then this would have been the price on the 15th of March. This would have been the price on, the calendar year 2022 in January. It would have been a peak point of about 15 cents on real time had you been consuming that power in December of 2022, and so on. So this is the real time market, which is completely different than the forward market. So to show you that example further, if you had a custom forward price where you would enter in a location, a start month, a term length, a facility profile, and a volume. Now, this is a custom forward price for a start month of, say, April 2025. You can see for this same period, this pricing ranged from about 3 cents to 6 cents. If you looked at the day ahead pricing for that same period, it ranged from about 2 cents to 15 cents. It's trending in a downward direction. The forward market that, say, this particular client or end consumer was interested in is trending in an upward market. So the point to this is, when you hear the price of energy is either going up or down, you really need to know, and this is overlaying both of them together, both of these graphs, the day ahead or the real-time market, which is consuming it on that given moment, and then this custom forward market, which means locking in for a forward term. They're two different things. So you need to price monitor for your custom forward term and not necessarily just be listening to the headlines and what the newscasters are saying with, say, real-time pricing or near-term indices. It all comes down to your forward term, your forward start month, your profile, your location. So what we have seen a need for with end consumers, as well as consultants and brokers that support end consumers, is a technology that automates the monitoring of each one of these forward terms and custom pricing.
Interesting. Okay. So, since Energywise is a customer of yours, and as a consultant, we bring our customers to the table to offer them support, advice, access to these types of reports. Tell me what as Energy Pricebook, what are you offering us that we then pass along or can offer to our customers that will be helpful in making help them make decisions for future contracts that they put in place?
Best way to probably explain that would be to tell, a quick anecdotal story. So the slide that's coming up there, and I'll explain exactly what this is, but by and large, remember the previous slide that we looked at that showed the timeline from 1999 to say 2023?
Yeah.
There was a period of time, probably for about 15 years, that you could cyclically buy electricity in the shoulder months. And a shoulder month is basically April and May and September and October, or maybe even sometimes in October and November.
Yeah. So
And
the mild months, the months where you don't have
the
to run a
mild
ton of heat
months,
or electricity
correct. And
or AC.
correct. So cyclically, you could say, you know what, we're going to wait to the shoulder months to buy. Well, one of the things, especially in the last 3 years, that Pricebook technology does, which again, this technology mirrors what the supplier pricing desks are doing. So it calculates current day and historical custom pricing on a given set of inputs, just like when you would go out to bid for your suppliers. So it then gives you, with current day and historical pricing, it enables you to have this monitoring ability that you see on the screen here. So let's just talk about
Hmm.
that for a minute. So in this case, this one is a facility in Texas. It has a start month of July 2025. It's looking at 3 term lengths. It has a facility profile, which is a manufacturing in the metal industry, and it has a volume of 2 million kilowatt hours a year. These are the same inputs that your supplier pricing desks would use when you go out to bid. So our markets for Pricebook are both on the buy and supply side in terms of automating this pricing, because the suppliers have two internal, not necessarily competing interests, but they have sales reps that go to the supplier pricing desk that say, hey, we need a refresh pricing on this account. The supplier pricing desks that have limited resource ask mainly this question: is this thing going to contract? Is this for real? Well, then the sales rep comes back and says, I can tell you it's not going to contract if you don't give me a price. So what ends up happening is supplier pricing desks resources are strapped just to give indicative pricing, meaning where's pricing today? I might not contract today, but I just want to get a feel for where I'm trending for my specific custom pricing. So
Hmm.
Pricebook answers that question for both the buy and supply side, and it automates it, and it does it within seconds, which would take years or hours of manually refreshing bids. So what you see here are the inputs on the left and then the output on the right. And in this example, you'll see the supply, which is pricing in at 7.79 cents. And we're just going to zoom in for a minute. And you'll see as this pricing is trended and calculated as of this day on May 24th, 2024, and it priced it all the way back to January 1st, 2021. So what this is saying is Had we contracted on June 4th, 2021, this price would have been around 4.25, 4.25 cents for that July 2025 forward start, for this term length, for this profile, for this location, etc. That same price request is now at 779. So your signatories and stakeholders can immediately see this graph of custom pricing specific to them. So back to, where's the value in this? Well, remember that, I'll say, cyclical buying in the shoulder months. It used to be, hey, we're going to wait till the shoulder months to buy. Well, this data, which is accurate data, and it's just as though you would have had suppliers price it. Notice in these shoulder months, in the September, October, the April, May, and then here it's sideways, here it's a little bit down, but then September, October, November, and then look at the most recent shoulder month.
Wow.
This would tell you, for this particular account, for this particular start month, the shoulder months are no longer buy opportunities, again, for this particular account. And without this type of technology, you would not have had this information. We would have been operating maybe on 10-year-old practices to say, hey, let's wait for the shoulder month. And just as one other side note, and not to get too long-winded, which I've probably already passed that point, one of the questions that come up, and this is that graph we just looked at over here, is, when we can't confuse locking in a forward term during the shoulder months, be it April, May, September, October, and confuse that with the typical low prices of the forward shoulder months themselves. Let me say that again, because that's a little bit of a complex statement. Don't confuse locking in a forward term during the shoulder months with the typical low prices of a forward shoulder month. So in this exact location, you see at the bottom of this graph, the shoulder months. In this case, I picked September and October and April and May. And you'll see each shoulder month, as you go out in time for that particular forward month, it is a dip. And you'll see it. It happens cyclically every, shoulder month. Well, that is actually the price of that particular forward month in September 2024 or, May 2028. So what we can't confuse is the typical low prices of these forward shoulder months that we're wanting to lock in with actually locking in a forward term during the shoulder months. I know that was a mouthful, so I hope that made sense.
Yeah, so let me see if I understand that and can spit it back out to you. So while we recognize that during those shoulder months, if you were buying today's energy costs, those are less costly because you're buying a term that is going to include those, that the average of those lower costs is going to be embedded in your contract price and included there. But that does not mean that timing your purchase during those shoulder months is going to be to your advantage. It could in some cases be, and in others, very likely not.
That's correct. And 10 years ago, Scott, you could have easily just waited for the shoulder months and prices would have fallen. They would not have looked. Things didn't look like this 10 years ago. You would have seen a dip in the shoulder month, a dip in the shoulder month. You would have not seen this graph. And that's why Pricebook exists today. That's why this is being used both on the buy and supply side, both by end consumers and consultants, because all bets are off in terms of what used to be in place cyclically is no longer in place, which requires levels of automated monitoring. And that's the type of technology that's out there. And those that are going to lead energy procurement and risk management are arming themselves with that technology.
Right. So, in a nutshell, it looks like we've got a couple of different levels of service that Energy Pricebook offers to me as the client that I can pass along to my customers for them to be able to take advantage of finding the right timing and opportunity to put their new contracts in place, whether they're looking at putting contracts in place for the short term or just looking out to the future and finding where the right buying opportunities are, say 2, 3, 4, 5 years down the road. So if we could maybe just end this conversation with the two different levels of service and the two different types of report, although they're reporting some of the same information, maybe put it kind of in a nutshell for us so that the audience understands what they would get if they call Energywise and said, hey, look, I need your support. Obviously, we would look at their account probably based upon the size of the account, what their energy spend is. We might want to provide them with X level of service and a product that we can purchase or get from you guys. And if they're at another level, a high enough level, and need more frequently updated data, I guess maybe is the way to put it, there's a different type of reporting and a different service. If you could maybe just give us that in a nutshell, that would be helpful, I think.
Absolutely. So the one thing just to mention, and again, I'm not going to go into this in detail, but it goes to how long prior to your contract expiration should you be monitoring the price? Let's say I just locked in the 3-year term. Do I need to be monitoring on day one for when this thing expires 36 months from now? Day 2, month 3, etc., month 4? And what we did at a high level, and we'll provide this data, as notes to the podcast. But if you look across multiple hubs, this was in PSEG, Encore, and ComEd. And what we did with Pricebook technology, which again mirrors exactly what the supplier pricing desks are doing, we calculated high and low pricing for the 2 years that led up to these particular price requests. And we did price requests starting in January with an April start, a July start, and October start. So for each one of these areas around the country for a given term length, forward term length, there were dozens of price requests made. So we went in and there were high and lows in terms of where pricing was. So what we did was say, okay, what if we monitored pricing, and how often was the price within 10% of the 2-year low, namely this column? How often did it hit in a given week? And if you started monitoring 2 years prior to the contract starts that were listed here, you would have hit 53 weeks of capturing a low, say for calendar year 2022, and for these various starts. And you'll see these numbers be 53 times, 17 times, 18 times, meaning how many times are you hitting a low and seeing it? Now, notice as you move to the right side of this chart, doing it 1 year prior, 6 months prior, 3 months prior to the start or to your contract expiration, you start to see the opportunities start to fall off drastically. So the point being is, even once you contract, you want automated monitoring to kick in for your next renewal term. So you are seeing opportunities, or at least having the advantage of capturing the market at low points or at dips. No longer can you just wait to say, oh, I'll wait till I'm 12 months within my contract cycle and then I'll look at it. Those days are really over, because you could really be putting yourself in a corner.
Well, now, I think to that point, I can tell you just based on what most of my clients do, is they typically in the past, they haven't been interested in even taking a look at that until they get to a point when that contract's almost due to expire and they know they need to renew. Sometimes we ask them about it and they decide they want to put it off. It's not something that they need to take care of. And once we get within about 90 days and they start acting on, executing a new contract. What you're saying is whether that be a daily, if it's something that you can put in place, or perhaps a weekly monitoring, you need to have something in place where you're regularly looking at where the right opportunity comes into play for you to execute those next contracts.
Exactly. And one of the reasons, Scott, why your clients say, look, I'll deal with this 90 days ahead of time is because they're too busy doing 100 other things that they should be doing to run their business.
Right.
And the other reason why they're too busy is historically, all they would see would be 3 price points from suppliers. And it doesn't give them enough information or context to price monitor. So what you're seeing on the screen here is an output from Energy Pricebook. This is one of the service offerings that you mentioned, where you would literally have a custom price for a given set of inputs. In this case, it's in New York Zone J, a start month of July 2025, term lengths 12 through 36 months. This is the profile and this is the volume. And what automatically gets calculated within seconds is today's pricing. In this case, this was May 2029 when it was run, and all the historical pricing had you done a manual price refresh for this forward term last week, last month, last year. So now imagine your busy quick serve restaurant owner who's doing a million other things. They may have locked in a contract that doesn't come up for 18 months. They now see this information and they can see, okay, do I have a particular market dip? They may look at this information right now and say, you know what? I want to set a low trigger in place, or I want to know when it gets down to maybe a 2-year low or a 6-month low and come ping me again. So this is where the automation comes into play with setting automated alerts. That's what these red lines are in terms of lows and high triggers. So now you can set it because once you submit this price request, it refreshes every day. So that busy business owner who doesn't have time to think of this electricity supply contract until 90 days, and now in today's market, it's usually too late, can now automatically be notified when they're at certain low thresholds or conversely high thresholds. So it can immediately get their attention when the attention needs grabbed, and they can address something in a forward market that otherwise they wouldn't have had the opportunity to do so but for this technology.
Wow. Yeah, that looks like the triggers that I have on my stock trading charts.
Yeah, and the other piece to triggers, and this is an example of a price trigger, but the technology also does every day, are we at a 6-month low, a 12-month low, a 36-month low? And conversely, are we at a 12-month high or a 36-month high? Because a lot of folks don't like coming up with strike prices, whether you're the internal energy manager or on the procurement team or the advisor. Because as soon as you set a strike price, you're wrong. You know what I mean? That's how life has it.
Yeah,
However,
yeah.
signatories we have found are much more amicable of executing and locking in a price when they're at a, say, 6-month low or a 12-month low. And that's another trigger that the technology calculates. So it's not just a straight cents per kilowatt hour. It's, are we at a given low, or conversely, are we at a given high if we're in a rising market? Because some of the risk management practices are, as the market continues to rise, we may have thresholds where we're going to lock in at a given rise or high trigger, so we dollar cost average on the way up and secure our budget certainty. So the point being is there's many different ways to manage it, but without this level of automated monitoring and automated alerting and giving you current day and contextual historical pricing, folks are operating in the blind because what worked 10 years ago isn't working today.
Wow. Okay. That's good stuff. And I'm just looking at this and I'm trying to calculate in my mind what the difference would be in the high trigger and the low trigger if you were using 15 million kilowatt hours per year. It's pretty significant.
Correct.
So great stuff here.
And,
Well, Mark,
and not to
this has
mention, look at
been
the
very
existing
enlightening.
price.
Yeah.
And that in this particular example, they're looking at a budget increase in this particular example, probably any way you cut it, because the price isn't going to come down to 9 cents.
Yeah. Mm-hmm. Right.